disclaimer out of the way here. And it's like, Rand Walks is not a broker dealer, nor investment advisor. This presentation is strictly for educational purposes only. Be careful when you're paper trading and start small, and just be careful out there. So no investment advice, that type of thing. So, and this will be recorded. Will the attendees get a link to the recording? I had a couple of people ask me that.
We'll make one available, Ed, and
Okay.
You can always provide it to people too.
Okay, I could do that. They don't get out there. So the agenda that we're going to have tonight is we're going to go over a scenario, and then what to trade, what strategy do we want to use, oh my, so many butterflies. What is volatility for some of the beginners getting into options, and then the life cycle of a trader, and then we're going to do just a quick recent trade example that kind of helps tie things together for you, and we'll go from there. So here's the situation. You're at your favorite coffee shop, and your best friend says, "Hey, I know you trade," and he wants to make the most of his $10,000, and he's asking for your advice. And he's like, what advice would you give him, given the fact that he's going to give you some want some trading advice on how to invest it. And obviously there's a million different answers to that, but we're trying to keep it safe here because since you're your best friend. And a simple example here is, we could simply buy stock. It's pretty simple. This is done a couple of weeks ago. Apple was about $140 a share. Amazon was $3,500 a share. Tesla's $680 roughly. And Apple, you could buy about 71 shares, and that would tie up almost all your 10K. Amazon, you could buy 2 shares. You can't do fractionals in most brokerage platforms. You got to get a whole shares. That tie up about 7 of the 10 grand. And Tesla, you could buy about 14 shares, and you're going to tie up about $9,500. So you can, allocate almost all of that to that, but that's not recommended. And typically as traders, you only want to risk 2 or 3% in a position. You don't want to risk your entire balance on one underlying or one product in your portfolio. Risking 2 or 3% is kind of a starting point, and then kind of working your way down to 1 or 2% of your capital on hand kind of keeps you in the game. And obviously, we can't control the price of a stock, and we want to play another day. As traders, we want to find our setup, make our money, or take a loss. But you're not going to last long if you're going to be batting big chunks of your capital. We want to preserve the capital as much as we can, and take your small little shots and look for your setups and stuff, which we'll get into here. So obviously we know that the price of some of these could go lower or even to zero, hopefully not. Reverse stock splits, that type of thing. So just we want to manage our risk, and eventually the profits will come. There's always going to be a trade setup waiting in the wings, and we can find a trade setup and take that next trade. So so from a very beginner basic level here, we can use options instead of buying stock. One option controls 100 shares of stock. You're buying one option gives you the right to buy stock at a certain price point called strikes. Likewise, selling an option obligates one to sell stock at a given price point. So you can sell it, but you're obligated to deliver stock at that particular point. So and there's all kinds of different reasons why you might want to do one or the other or both, which is what we're going to be talking about tonight. So we can buy and sell calls and puts. We can combine those strikes and create many other types of strategies. Just like there's like 12 different iPhone models, or I don't know how many other are now. There's just many strategies that we can combine, either buying or selling calls and puts, or combining them. So don't let that deter you if you're just a beginner. You start with the basics, and you work your way up, and it fits like a jigsaw puzzle as you get to learning through your learning career. So this is a little chart I like to use that kind of shows, some different strategies that we like to use depending on if you've got a bearish bias or a bullish bias, and also what do we call implied volatility, or IV. Low IV would implement certain trading strategies, and higher IV is more strategies that we like to use. And many traders like to sell premium. So if you're selling premium, you like to have a little higher IV so you get a little bit more credit for your risk. So your risk reward's a little bit better. Lower IV environments are good if you're expecting IV to increase, and you can actually use different types of trades in those scenarios. But there's a multitude of different strategies at your disposal, and each of them has a different purpose. Think of it like a toolbox. You got a hammer, you got a screwdriver, and sometimes you got to bring out the power drill or your power screwdriver. There's different instruments used for different trading scenarios. So your mission is to decide, which strategy to use. Do we buy a long call, long put? Do we do verticals? Do we do condors? Do we do calendars? Do we do butterflies? That is the $100,000 question that we're going to kind of tackle tonight. And today we're going to focus on butterflies, and my take on it is just, my personal bias is, the risk reward is the primary reason. Because if I'm risking $1 and it can make 5 or 8x that, that's a lot better risk reward versus other scenarios. But first, we're going to go over some basic butterfly types and kind of compare why we use certain butterflies in certain scenarios. So just some beginner basics in butterfly land here. So the basic butterfly here, I just pulled up, this is SPX. A butterfly consists of a long spread and a short spread. So a long spread in this case is 50 points. The long spread is the 42, not the 42, the 2420, the 2370 put spread, which is a long put spread. And then we're going to sell a spread against it, which typically is going to be at the same strike price. So we're going to sell the 2370 and 2320, also 50 points. So if we're going to buy a 50-point spread, it's going to be a pretty big chunk of cost or debit cost that we can incur. And then selling a spread, we receive a credit. So if we take the debits minus the credits, like in your checking book, checking account, we're going to end up with a cost of $3.50 times 100, which would be $350 in this case. And in this example, we're doing 5 contracts, but just the basic butterfly structure is kind of what we're talking about here. It's equal distance on the longs and the shorts. So just a simple vanilla type butterfly. Each has its own purpose, but a butterfly is going to have the same short strike in the long spread and the short spread. So in this case, the 2370 is the short strike in our butterfly, and that's why we get the little tent there at the 2370. And if we sit there at expiration, we can make our maximum reward. So I think I can do this here. If I got my annotation going on. I think work. Let's see if it'll let me do it. There we go. Let me see so I can do some drawing here. So right here is the short strike. And in this case, our max risk is the $350. And if we just kind of follow this all the way to the y-axis here, it's around 20K as far as max profit. So you can do the calculation of 350 max risk versus a potential of a 20K reward is a pretty good return on your money. But butterflies, obviously they have to land inside the butterfly here to make some kind of profit. So that's where we're trying to position it, and you can use technicals to position your butterfly, but that's just a simple example. Oops. Of the butterfly. So let's see if we go to there we go. And the next example here we got is the broken wing butterfly. And the broken wing butterfly is very similar to a symmetrical butterfly. So we still start with, you know, the 50-point long spread. So long spread is this little chunk of this line here. So this is the long spread. And this guy was called X. And this guy is the short spread that we're selling. And this is wider than this guy. So I'll put this, well, I should have done this reverse, but it's hard to draw with my mouse, my trackball. But anyway, this side here, since it's longer, we're receiving more premium. And what we're hoping to do is to pay for the long spread here. And you can see we're going to receive a 50-cent credit. And again, if you're new to options, you multiply by 100, you're going to receive a $50 credit in your account. We're doing 5 contracts, but that equates to a margin. So you're going to need to have at least 5K in your account, or have a margin account to handle that. So we won't get into that. But just from a broken wing standpoint, a lot of people like broken wing butterflies. They put them on for a credit, and then as time progresses, they can take it off for a credit. So if you put a trade on for a credit and take it off for a credit, life is good. The next up we got is what we call a 1-3-2 butterfly. So a 1-3-2 butterfly is different, such that the same 50 points on the long vertical here, but the difference is we're selling twice as many short verticals against it. In this case, the 50 points are long, which is this guy, and then the shorts is basically 30 points. So the distance from 2370 to 2340 is 30 points, times 2 would be basically 60 points. Now, again, I am getting a 50-cent credit. What is the difference? Well, the biggest difference is you're going to use a 1-3-2 butterfly to get some more theta. Now, in our previous example, we're like -10, -11 theta, but we're outside the butterfly. But since we're selling twice as many, we're collecting more premium. So because we got twice as much shorts that we're selling against it. So usually, typically you're going to use this, less than 21 days or even 10 days, because theta decay is rapidly decreases under 30 days, and obviously gets quicker and quicker as you get to expiration. So a 1-3-2, you can get some nice credits, particularly if you're looking to put a trade on. It's very short duration, 21 days or less. Sometimes you can't do a broken wing butterfly for a credit, but you might be able to do a 1-3-2 butterfly and get a credit and get that butterfly on. So that is just a kind of quick example of a 1-3-2 butterfly. So we're long one spread and then we're short 2 verticals on this guy. And next up is what we call a Venus butterfly. And a Venus butterfly is something that I came up with some years back. And a Venus butterfly, you still have the 50 points on your long spread, but on the short spread, instead of being, broken wing, which is going to be, longer, the Venus fly is going to be shorter. So this is 40 points. So what that allows us to do is to basically raise this part of our risk graph up. So in a broken wing butterfly, you can have some margin here. Here, if the butterfly or if the underlying continues to go all the way down and go through the butterfly, I still can make some money down here. So these Venus butterflies I typically use in a directional bias. So as traders, we know that you can make a play to the upside if you're bullish. You can make a play to the downside, or you think it's the underlying is not going to go anywhere, so it's going to sit there. If you have a directional bias, instead of using verticals, we will use a Venus butterfly because I can adjust my deltas, but depending on how far I want to lift this wing up, but it also gives me a nice cheaper cost to play that direction with some potential to make some money in the trade. And we're going to talk about how this fits in with some of the other butterfly cousins that we have. But that's what we kind of call a Venus butterfly. We use this in directional bias. Typically broken wing butterflies you're waiting for time to decay, to collect your premium. In this case, we're using this as a directional instrument to play. You think Amazon's going to go up, or was it Facebook? I think went down today after earnings. Balance fine normally. Yeah, so the question is, the balance fine normally done for a debit? Yes. If it's symmetrical butterfly, you're typically going to put that on for a debit. Venus butterflies, it's going to be cheaper. In this case, it's $350. And what I tell students is not, you can make the case of a vertical. So vertical is if you just did this long put spread, for example, which is perfectly fine, your risk graph's going to look something like this. And what I mentioned to folks is when we do Venus butterflies, I want to make sure that this short spread here, in this case, the 40-point spread here, I want to make sure I'm getting at least 25% of the spread width, because if not, and the IV is too low, you're better off doing the straight vertical, or in this case, the long put vertical, because when IV is low and you don't get that much for your short spread here, the cost difference is going to be minimal. So you can compare the cost by structuring a Venus fly and then structure just a regular vertical. Just do a vertical with the 2420 and 2730 and compare the cost. If the cost is very small difference, then just do the regular vertical. But most of the time we're structuring this Venus fly because we're in a high IV environment. We expect the underlying to move either up if we're doing a Venus call fly. In this case, we're doing a Venus put fly. So that's what we kind of call the Venus variety butterflies. We do a lot of these. And now we get into what we call stacked butterflies. So in this case, it looks a little busy, but a stacked butterfly is basically a cheap way to increase a profit area. So keep in mind what we just looked at with the Venus butterfly. Let me just pull this guy out. So remember, this is the previous Venus butterfly that we just talked about, and then I'm talking about adding this guy. And when you add this butterfly to this butterfly, you notice that from a margin standpoint, there is no large margin. Many times traders might buy back the shorts for 50 cents or something like that. Well, I'll take that same 50 cents and buy a butterfly with it. And note this profit area. This is 40K. And if we go back to the previous slide here, let's go back one here. Let's just pay attention to go back. Notice that this profits that we just talked about, and this is 20K. So we doubled the profit area for basically the same amount of monies. So we do like doing stack flies. And what we do many times is if the underlying goes in the direction that we want, we'll add that stack fly and add it for a credit, and we take back the 350 debit that we paid initially. So and that's not a bad scenario to be in. So so the Venus flies and the stack flies really they're cousins. They live next to each other on the same street. But the other thing is that when we talked about stack flies, this is what we call an outer stack fly, where we add a second butterfly outside the original one. If we add it before the butterfly, it's what we call an inner stacked fly. And another bias would say, well, the inner stack fly is always going to be more expensive. Well, if you've done enough of these, you're going to find out that's not always the case. And the reason that we look at that is if I add a butterfly, on the inside here, I'm moving my break even closer to at the money and creating a higher probability trade, plus doubling the profit zone as a bonus. So I always tell students, look at both, depending on where you think it's going to go, but look at both butterflies and see which way you, and again, you can window shop. You can leave in your analyze tab and toss. And if the price grabs your attention, you can jump on it. But it's a nice way to kind of help lock in some monies or lock in some profits in a trade. So, whoops, sorry about that. Wrong button. There we go. Sorry about that. All right. So, so the question would be, what is the which butterfly is the best butterfly? Well, different butterflies are for different uses depending on what the market does or doesn't do, and if you want to receive a credit or if you're trying to increase profit zone. So, many times, as I again tell students, is a lot of the work is done outside market hours, where we're kind of manipulating the risk graph and looking for different butterflies that we can add with very small cost, not as so much as a credit, but how do I move risk from a trade, or can I lock in another butterfly and receive some credit? And then as the market is open, you can go shopping and saying, I'm looking for this type of butterfly, looking at expected move and seeing the cost of that butterfly if it goes up or down. But one thing that we know butterflies like is what we call volatility. So for some of the new folks, the beginners, volatility is how much the underlying or stock can move. It can move up, it can move down. The higher the applied volatility, the larger the butterfly can be created, or you can create a smaller butterfly and receive more of a credit. Again, there's no right or wrong there. Some traders, they like to have the bigger butterflies. Some like to be more conservative and maybe get a credit. It just depends on which way your brain's wired. We're all wired differently, but there's no right or wrong there. But obviously, the more monies you get for the butterfly, the more monies could be put in the trading account. So from a high level overview, just decide from a life cycle of a trader, you got to decide what area of the stock market to learn, and this is not only for just trading, but any basic career or skill that you're trying to acquire. To be good at that subject matter, you're going to spend about 2,000 hours mastering that subject. The more passion one has determines on how fastly you absorb the material, and learn and all that kind of good stuff. You can learn the trading basics, the basic strategies, learning your trading platform, learning money management. Those are some of the key ingredients to keep front and center as you go down your trading career and learn the ins and outs of trading. So the other thing is to decide what combination of fundamentals, technicals, and or social media content. So this is something that came up in one of Jack's Schwarter's Market Wizards books. There's a trader he profiled, and then there's actually just using social media. Wasn't using technicals, wasn't using fundamentals, but he's using social media feeds to judge which way stocks would go up or down, and he's quite good at it. But in the case that we're using here tonight, we're looking at Amazon, we're looking at Apple, and we're looking at Tesla going up, down, or nowhere. In all cases, an option trader can make money. So that's the beauty of options. You can make money in all three scenarios, depending on which way you want to structure your trade and what expiration and all that fun stuff. So the other part of this is finding your setup. There's no one indicator or holy grail indicator. It's going to work 100% of the time. So if you're just starting out, don't be on that hunt for the most perfect indicator. Indicators, by definition, is the first derivative of price. And once you start getting the first derivative off of price, there's gonna be lag, but there's pros and cons. But finding the trade setups that look at and follow your entries and then execute your trade plan is going to be key. It's important to make sure you keep your emotions in check at the door, because once the market's open, you can test your stamina. If the profits go your way or go against you, can you handle the risk? If it's too much for you, you're probably trading too big. But you're just there to kind of make sure you execute your trade plan, and it's an important key. Learn as much as you can from your closed trades. It's amazing how much information you can learn. Did you follow your own trade plan? Did the underlying cause you to adjust too early or maybe too late? But did you follow your plan, or did something come in from left field and direct you to make a adjustment or a trade to close it out too early or too late? So following that and just sharpening this all and repeating that will make you better and better. And then I say treat trading as a business and not a hobby. The more you create processes for your trades or trading and keeping your emotions in check, definitely will pay big dividends in your trading career. Think about it this way. If you're going to the beach or the mountains for a week, could you give your neighbor instructions on how to manage your trades or monies? I mean, I know if I go to visit my neighbor and said, hey, can you help look at this iron butterfly position while I'm out for a week, he would look like I had, 3 heads on or something. So you get, keep a systematic and keep that process together. And kind of rate yourself. You typically, the worst thing you're going to do is kind of fight with yourself. And if you start talking to yourself, it's a different story. But you want to be systematic with your business and just keep finding ways to improve each of those different areas. So that's just another high level thing to keep in mind. But we take that and we apply that to our example of the $10,000 that we had to invest. And here I've pulled in the IV rank. So the IV rank is showing the implied volatility, in this case for Apple, Amazon, and Tesla. And we can see that Tesla is around 30%, and then 26% for Amazon and 13% for Apple. Now, remember what we talked about butterflies. Butterflies like implied volatility. So the higher the IV rank is typically where I'm going to gravitate to. And in this case, we're going to use Tesla. It's got the highest IV rank. But also keep in mind, if there's an earnings event, obviously that's going to make things increase. But sometimes we play right through earnings, but we've already got a plan in place to do that. So, and so the example here is if Tesla goes up $30 and we had 14 shares, you're going to make $420 profit based upon the price. Your risk is going to be those 14 shares times roughly $680. It's going to be $9,500, which is a no-no. We said we don't want to put all of our money into one trade. And your ROI is going to be about 4.4% just from buying the stock. And here I just put in a chart here. We're looking at weekly and daily charts. One thing I'd like to do is to have multiple time frame analysis, looking at weekly charts and daily charts. And if you're bullish, both charts should be kind of in an up mode. If you're bearish, both of them should be in a downward mode. So I like using multi-time frames to make sure that I'm not swimming upstream against the grain, so to speak. And then we have a little IV rank charts. This little squiggly line here is the IV rank as it kind of wiggles up and down. And then we have volume down at the bottom. So just to get a perspective of what Tesla may be doing, and then we can craft a trade from that. So if we assume that Tesla is going to go to 820, so looking at the chart here, let's back up a step here. We're just picking a point of saying roughly, 820 is kind of where we think it's going to go. It's going to bounce higher, and your bias may be different, but either case, what we're trying to do is construct a trade here with butterflies. And if we think that Tesla's going to go to $820 by August 6th, here we just got a simple symmetrical butterfly for $1.08 or $108. Remember, one option contract controls 100 shares of stock. So we can spend $108. Pretty nice risk reward, almost $1 to make roughly a little over 2,500. And then if we shift gears and say maybe we do want to do a broken wing butterfly, and in this case, it's going to cost $28, 28 cents, but $28 with a max profit about 2,900, which is a little peak at the top here. And the max loss is about $1,000 if we go past 850. So for the broken wing butterfly fans, this could be fine. It's a small debit, but you're looking for theta decay. In this case, we got about $1 a day, and that'll kind of just start melting away, and the butterfly will start growing if it goes in your favor. But if it goes down to 500 and drops, you're only going to be out $28. And another scenario here is the 132 butterfly that we talked about. So in this case, it costs $10. And again, pretty similar risk reward. We can make 2,900, and we can also lose 1,000. And lastly, the Venus Butterfly, which is if you're directional, which we are, this trade is going to cost you $178, max profit of 2,900, and your max loss is $178. So there's no margin in Venus Butterflies typically, because this outer wing here at 840 strike is lifted up. So if Tesla's really takes off and goes to 900 tomorrow, you're still going to make $1,000, but your max risk in the trade is what the cost of the butterfly that you paid. Yeah, so the question about IB and IB rank, so there is implied volatility, and then the IB rank is the range of implied volatility over the last year in this case. So what we're looking at is where that implied volatility falls within that range in the last 252 trading days. Yeah, and if the IB is too low, so that's if the IB rate, so in other words, can IB be too low even though IB rank is high? Yes. So generally, if you got higher implied volatility and higher IB rank would be a good scenario. That's why we always compare that vertical cost versus the butterfly, just for that reason sometimes. But in general, yeah, you're correct. So if we apply this, with just applying, if we just want to do the number of butterflies, we can buy 92 symmetrical butterflies. We can do 9 broken wing butterflies. We could do 9 132 butterflies, and we can also do 56 Venus butterflies. But we're not going to spend the entire $10,000 because we want to be smart with our money. So this is just hypothetical, and we're not going to do it. But if you were to do 92 butterflies at $1.08, you're going to tie up about $9,500 to make a theoretical 250. It's a small chance, but you can see the power of the butterfly from a risk reward standpoint. We're only going to do 3 butterflies from the symmetrical standpoint. But if we only risk 3% of the total capital, or $3,000, we can buy 27 symmetrical butterflies. So that brings our max risk to $2,900 and change, with a max reward about $77,000. Now, a note on the risk reward, we're risking $2,900 roughly for $77K potential, or ROI of 2,600 and change, a little better than the 4.4% with just buying the stock. But the probabilities need to be considered as well. So everything would be rosy. John, we're using 3% of the 10K capital. So
so wouldn't that be $300, not $3,000?
Yes, my bad. So we'll add a 0 to the account. Likewise, if we did 30% max capital, we're going to be, because with a 10K account, it's 30%. Typo. Concept's the same. Likewise, if we're using that 30% max capital, buying only the 3 contracts, we could do a broken wing butterfly, and again, spending the 28 cents times 3. We're roughly going to have a small, $84 risk, with a max risk once we get above 850, or above 860 here in the case. Here you're going to have margin tied up, but again, you're reducing the initial cost of the butterfly, and you want to take advantage of that theta decay. So depending on how you want to play that, you may want to do the broken wing, and then you really minimize the risk. Ideally, you can we try to get this on for a credit, maybe a quarter credit, help pay for commissions, exchange fees, that type of thing. Likewise, we could do the same thing with the 132 butterfly. And if we're to keep to $3,000, then we have a max loss of $30 on 3 contracts. And again, I just put a little note here. TOS doesn't do it all the time, but on the upper right-hand corner, you can set that date to the expiration date of the option chain that you're looking at, and you'll see this little, the gray. We got like a lighter gray here and a darker gray here. That just shows you the edge of the 1 standard deviation. So from a mathematical standpoint, the plus or minus 1 standard deviation means that you've got a 68% chance of staying within that shaded area. of the underline. Doesn't mean it has to, but it can. It has a pretty good chance of maybe getting in there, and you can take some profits. And likewise, if we use that $3,000 figure, we could buy 16 contracts of a Venus butterfly. And this is an alternative to buying straight calls or puts, and particularly in Tesla, because the prices of different strikes are all over the place, and even verticals can be expensive. So that's why we like using the Venus butterfly as a surrogate, as a directional bias. So in this case, we're bullish. If you're bearish, you could just do the opposite using puts. But again, doing this, we do have $2,800 at risk if we did 16 Venus butterflies in this case. And then this chart is basically overlaying all the different trades that we just looked at onto one risk graph, comparing the different risk rewards. And obviously there's pros and cons to each of these, entry costs, max margins, that type of thing. So that's another discussion for another time. So in our example here, if Tesla goes up, we make $420. But in this case, we look at the max, and that should be 30%, my bad. 2,900 would be the symmetrical butterfly, as far as $84 versus 3,000. So $30. So now we got a little laundry list here of which one, better perspective as far as how much capital do I want to put at risk, what is my upside. And we were very determined or very focused on our risk reward, or as far as whether it's a vertical or a butterfly. The basic premise of a good risk reward is, if I pay $1 on a 5-point spread, that's decent, but I'm not going to pay $3 or $4 on a 5-point spread. We want at least a 3 or preferably 4 to 1 minimum risk reward, whether it be a vertical or a butterfly. Because we're trying to have, traders, as traders, we're trying to have, some kind of edge in the trade. And determining targets, do you leverage technicals or expect to move? Determining targets, well, we do a combination of things. We use fibs, we use the moving averages, and expected move, we use the 5-day average true range. The average true range, for example, the S&P has been around 40 or 50 points, and we use those 40 or 50 points to judge the cost of these 3 butterflies. So you can take this, and it's another exercise, but we do this in our weekly classes. When we do put new trades on, we'll take that expected move and we'll kind of stress test the butterfly and say, hey, if it goes against me 50 points, what is the cost of that butterfly? Because we want to buy it on sale. We don't want to pay retail for the butterfly. But yeah, good question. Why to make the wings? So Greg, I'm imagining you're determining with broken wing butterflies. Yes. So in general, with broken wing butterfly construction, let's back up to broken wing butterfly for example here. So in this, we have a whole other thing that we go into, because each, besides the butterfly world of the different butterfly types, we go into great depth and detail, because a butterfly it consists of 3 strikes, right? You got your first strike, which is a 790, and then you got your short strike at 820, and then 860. Each one of those has a separate function and purpose. If you want to receive a credit, if, for example, this is at 28 cents a debit, if you want to make this cheaper, you got one of 2 options. One, you could move it further out of the money, which would be a lower probability trade, or 2, keep your first 790 strike and make the butterfly smaller, and that will make the cost go down and eventually into a credit. So you kind of think of like a balloon. You blow up a balloon, you squeeze it. If you want to get more credit out of it, and sometimes we do that. If the price is too much, we'll make the butterfly smaller. So this is when that implied volatility goes into the butterfly. You can make them bigger, but if the IB gets to be low and you just can't find anything, then yeah, we're going to go to a smaller butterfly. So Hopefully that makes more sense. All right. How do you choose the expiration? Eddie, the way I pick expiration is if the IV is high, I'm going to go out to a further expiration, 30, 45 days. When you got the higher expiration in the IV is in the upper third, for example, I'm going to capture more negative vega. So, when you're selling premium or butterflies or condors, most of your trades are going to be negative vega. And what vega is the implied volatility decreases, as it gets closer to expiration, it's going to go down. So I'll get more negative vega going out to a further expiration. If IV is kind of in the middle range, kind of just like in between 25 and 75, I'll go to a slightly shorter expiration. But that's kind of a general rule of thumb. All right, and then here is another type of butterfly. We call this a Bionic Butterfly, which is basically a 1-3-2 butterfly, but we're raising up the outer leg. So think of the 1-3-2 butterfly, where we pull that outer wing lower. In Bionic Butterfly, we raise it up like a Venus fly, but we are short twice as many. In this case, the 820, 830 call spread, which is a 10-point spread. We're doing twice as many of those verticals. And again, using the example of the Venus butterfly, anything above 694.05 level will make more profit than buying the stock outright. So that's when we kind of highlighted the 694.05 level, because if you get anything above that, you're going to be ahead versus buying the stock outright. So this is why I like the risk reward with some of these butterflies. You deserve more than a 4.4% return and more than 0.0005% on a savings account. So that's why I'm a big butterfly fan. What would your typical profit targets be? The profit targets, we generally, we're always working the trades to get the monies out of the trade. So in this case, we got $1.78 at risk. We're going to add trades to this and sell premium against it until we get monies out without inducing, we try not to induce a large amount of margin, because we are very cognizant of the fact that we're trying to maximize our return on capital. Yeah, I can sell a bunch of spreads here, but remember, we mentioned, good risk reward. If I'm selling a spread, I don't like selling spreads for less than a third of the strike of the width. So that's a big fancy thing saying if I'm selling a, what is this? Is a 820 by 840. So if I'm selling an 820 by 840 spread, which is 20 points wide, I want to get at least a third of that as far as credit amounts. And if I can, that's going to raise the entire risk graph up. So we're always trying to maneuver with our trades. And we're going to go through an example here in a second. He's asking a good question here. What are the probabilities of getting to max profit, whether you take profit or it goes your way? Adjustments if you're wrong. So excellent question, because butterflies is the light seems really bright and we all want to flock to the fireflies and the butterflies. Obviously a butterfly, you have a very targeted small window of profit area. Now during the year, we'll have probably 4 or 5 trades that will come pretty darn close to our short strikes. Doesn't happen all the time, but out of 100 trades, we'll get maybe 5 that end of the short strike. But with the adjustments and stuff, we manipulate the trades to get monies out of the trade. So you're going to see that here in a second. But how do you adjust different butterflies if you don't get the price maybe you expected or moving too fast in case of broken wing butterfly? Yeah, so Kumar's asking, so I'm assuming that you got a broken wing butterfly on and it goes against you. You got a couple different ways to approach it. Is let me just back up to a broken wing butterfly for a second. Here we go. And typically it's going to be the downside, but we're just going to use this just for a simple example. So I'm assuming, Kumar, you're expecting that in this case, Tesla zooms past it, you go past your break even, and now you're you're in the deep end of the pool, and you got this potential risk here, right? So as it's approaching, you can either, buy back the short and try to roll it out. We don't do much of that. What we do many times is we'll do a separate trade, a risk reversal. So in this case, here is the August 6th expiration, and a lot of the favorite stocks that you guys like to trade, the Amazons, Apples, whatever it is, there's weekly options, and we do a lot of trades that typically have weekly options. But we'll go out to the next expiration, maybe the 13th expiration, like a week out, or whatever the next expiration is, and we'll do a bullish risk reversal. And what is that? Well, a bullish risk reversal is basically we sell a put spread, and then we can buy a call spread to counteract the deltas, because this negative delta is what's going to hurt your P&L. So this new trade here is a separate trade. We treat it separately from this guy, because what will I'm sure this doesn't happen to any of you guys. You put a trade on, you make the adjustment, and what happens? Tesla goes the other way, and you just spent whatever capital, and you're left holding the bag. With this case, we can define where we're going to put that short spread. We can define this spread here, and sometimes if it does go this way, we'll actually flip this call spread, which is another technique that we do. We flip this call spread into a broken wing butterfly, and get it closer and put it on for our credit. So that's a whole separate discussion. But yeah, what you're trying to do is to counteract those negative deltas, because that's what you got to account for. So either you take it off, or you take off the what's hurting you is these short strikes, and move these spreads further out, or just do the next expiration. And when you construct this risk reversal, get something at least 7 deltas to counteract what you got here. So that's generally what we do. But all right, let's go back here. Good question, so. All right, so we got that. There's the Bionics. Did that guy. So here, again, just illustrating, if it goes up, $30 on Tesla, you make 420. And now you can see, a different way that we can kind of play Tesla versus just buying stock outright. Here we define max profit, max loss in your ROI. That's why I'm such a butterfly fan, is just from the risk reward standpoint. It's really fun, finding good trade setups, and we do a lot, as far as using the technicals, and then using price action and volume. And then also into pattern recognition, seasonal. So once you kind of get some of those basics down, and apply a strategic butterfly to them, you can get some really nice returns. But here we'll look at just a quick example, looking at a recent trade that we did in Tesla on July 2nd expiration, that we just started back into, I think it was May 28th. Yeah, May 28th. So this is, again, just a simple example that we did. In this case, we did a simple Venus butterfly. Oops. So we got a Venus butterfly that we did here, and we paid $4 for it. We did 5 contracts. So max risk here is $2,000. So that, worst case scenario, it goes south on us, we're out $2,000. Upside, yeah, we can live with it. And then here, we are also considering, before we even put this trade on, that we're going to put on a put broken wing butterfly, but we are not going to put it on for 62 cents. We want more credit. So we anticipate, from that expected move, that, yeah, we want Tesla to go up. And we know that if we pull a bullish trade on, the market goes south. Well, we use that expected move to figure out where can we get in to get a good price on this Venus call fly. But if it goes south, we know that this put broken wing butterfly is going to be more credit. So what does that mean? Well, let's see what happens. So that was on May 28th. We got $2,000 on the line. Tesla goes south, and we did put that broken wing butterfly on for a $3 credit. So we bought a Venus butterfly for $4, and then we put a put broken wing butterfly and get a $3 credit. So, oops. So this is our Venus, and then this guy is the Venus put fly, and we changed the strikes because the market went down, and I was trying to get some monies to pay for it. So, some, as you know, we don't know what the market's going to do. If it doesn't go down far enough, we move the strikes up. So you can see this was a 560 strike. We moved it up almost 20 points higher. Got the $3 credit as Tesla went down, which is good because when the market goes down, implied volatility goes higher, and if it goes higher, you can get more credit. And we locked in a $3 credit. Now, yes, we collected $1,500 and we spent $2,000. So, right here we got minus $500 if we kind of sit there, but we have induced some risk, some margin on the downside. So nothing comes with having our cake and eating it too, but we do know that we have a plan in place that we're going to kind of we're always looking for the next play, because if we are anticipating that the Tesla hit a bottom, bought a put broken wing butterfly for a credit, and if it does bounce higher, then we can take the appropriate action, and that's exactly what we did when it moved higher. So two things happened. One, Tesla went higher, and so this is where you kind of like bob and weave sometimes, but after you do it after a while. So Tesla went down, did the put broken wing butterfly, bought that for a credit. Then it went higher. So the first thing we did is, here is the 680, 685 call spread. Now, that was part of the original Venus fly that we had. And what I did here, and what we look at a lot, is this first 5-point spread. And, Apple might be 1-point spreads, but, I'd say in general, you got 5-point spreads. On a 5-point spread, the most credit you can get is $5, right? We typically shoot for 80%, which would be a $4 credit. But if we can't, in this case, it was getting close. It's June 28th. We got 4 days left to expiration. Pulled the trigger. We got 280 out of it, so it's about a 56% premium. So we locked in some premium. We collected almost $1,500 here, and still have a Venus fly configuration. I took that $1,500 and then I bought an interstacked put fly for 45 cents times 10. So I spent $450, and that added it right here. So you can see that doubled our profit area here. And now the entire risk graph is up above zero, and we got at least, worst case scenario, we're gonna make $450 on the trade with a call fly here, and then we got larger. If Tesla wants to come to the downside, we'll welcome it with all arms. With 4 days left, we'll be happy to do so. But this is what we take offensive, looking for those trades. What makes sense? If you got something that's in the money, we're looking to either take some premium, sell the first 5-point spread. If this was anything less than that, I probably would sell a spread further out or something. But we're just going to try to keep it simple here. So that was on June 28th. We got 4 days left. And then on July 1st, the day before expiration, we sold the next 5-point spread. So in this case, all I'm doing is I'm just nibbling. I'm just keep nibbling at this butterfly, each of these 5-point spreads. In this case, it wasn't the full 80%, but with a day left to expiration, there's not much stuff in the cupboards for the butterflies to eat. So it's a 5-point spread. I collected 250, so I collected 1250, and now worst case scenario is I can make 1700. We're sitting here at 681, and we're hoping that Tesla goes into the butterfly, or if he wants to do a major pullback, they can go into this butterfly. So we're just looking for those different scenarios. And then on expiration, expiration in the morning, Tesla ran up, and with that run up, it went a little bit further up, and I sold that next 5-point spread. So now you can see we've turned a Venus butterfly into a broken wing butterfly. So now this long vertical is shorter than this guy, because I keep selling these little 5-point verticals and collecting some premium. Now, in the perfect world, I'd like to get, $4, but you give what the market gives you. So in the morning, we sold that for $3, and I was like, oh, good, Tesla's going to run up, and if it didn't in this case, but still, we locked in some monies. And clear that out. It's sitting here at 695 in the morning, and it was like, hey, we just need another 10-point push, be a nice little winner. But it ended up didn't doing it, pulled back, I think, in the afternoon. And it came back with basically a $3,200 profit. And that's a 42.6% in 24 days. So we keep looking for those trade setups to add to it. In this case, it's basically 3 butterflies and 3 call spreads is a simple example. So this thought I keep it, again, try to keep it as simple as possible. But that's kind of how we look at the trades: is where can we take profits, where can we add without sinking a lot of capital. So in summary, like I said, we just covered some of the basics of butterflies and the different types of butterflies. Options give you a great leverage, if you use it wisely. We typically don't do anything naked. Butterflies provide a good risk reward, and we combine that with fundamentals, technicals, like I said, moving averages, big on price action, volume, pattern recognition, that type of thing. And combine that with the trade management, it can give you an exciting opportunity to help manage your monies. Knowing the risk, looking for your trade setups and executing the trade plan can be very rewarding. There's not many professions out there that allow you, to kind of travel the world, make money, get back to your favorite charity from the comfort of your laptop. There's work to do, but for those that take the jump, it's definitely worth every moment, because you're your own boss. I mean, if you want to fire yourself, you can fire yourself, but I don't recommend it. But just be humble, pay it forward, and think smart, trade smart, and go from there. So, and this is the only little promo thing that we do here is we do have a weekly options seminar we do every Thursday at 7:30 Eastern, and twice a month on Saturdays typically. We'll do a beginner or some kind of education-based webinar. It's $60 a month. It includes SMS text messages. Also, I have a Dropbox set up, so all the screenshots that you just saw, all the trades that you can, when you go into Toss, you can export as a text file. All that is saved in a Dropbox folder that you have instant access to. So as soon as I update it, it will refresh yours. So you get it as fresh as I get it fresh. So, and if you want the PDF of the butterfly glossary, just shoot me an email. I got a PDF of the butterfly glossary, if you want to call it that. And that will, we can send out to you. And lastly, I got this little Excel dashboard. It basically works on the PCs that it looks at all the different butterfly combinations, and it helps finding butterfly trades a little faster. But other than that, that's all I got. Let's see if I got any questions here. Is butterflies only apply to high price stock only? Or what is the perfect conditions for butterflies? Good question, Eddie. One of the things that we also use is as we get more towards looking at more, I say more technicals, but I've been getting more into technicals from a standpoint of the price action and moving averages, but also we use Keltner channels, and see if we've got continuation patterns, that type of thing, and find stocks. I've gone through some construction of finding, constructing scans, I should say, in TOS to help find candidates. Now, Amazon, obviously, no one can, I mean, it's meant for institutions. I mean, $3,500 instrument, your average retail investor really can't play buying stock unless you got $1 gazillion in your account. But options give you a really nice way to play it. We do tend to favor the SPX because that is cash settled and considered a 1256 contract. So there's some tax benefits doing that. But but yeah, we do have some sessions some Thursday nights, so we call a bull and bear session, where we'll look for a really good bullish trade, or and also a bearish trade, and see if we can find something, and we'll actually go through looking at the charts, and then we'll actually construct. The students decide what stock. We'll have like 3 or 4 candidates. The students determine what stock we're going to look at, and then from there we put a trade together, and then we see we get filled the next day. So do you have any signal service? I don't know what you mean by that, Miss Ed. I do mentoring, one-on-one mentoring. I do have students that like to do that, and we have students worldwide. We from Australia to Taipei, all over the place. But that's about all I got down, unless there's any other questions. Try to keep it basic. I know I went a little bit more advanced toward the end there, but that just it's exciting sometimes.
That's great, Ed. So people feel free to email Ed at ed@randomwalktrading.com for his butterfly glossary. And we have time for a question or a point, if anyone wants to, or two, if everyone wants to make one. Ed, what type of people do you find come to your service, and what benefit do they particularly look for, or what kind of student?
It's an interesting question from the perspective is because we have some like beginner, like what's a call and what's a put, and then we got like super advanced folks. So I have to balance things from like from beginner to advanced all the time, which is not a problem. I mean that's normal. And moving forward, on the Saturday classes, if I look at my emails and see where people want to, what topic they want to talk about, and then whoever has the most votes, so to speak, that's the topic we're going to talk about. We're making some updates here in the next few months. We're probably going to get into a little bit more of the price action in that, just reading charts and stuff. Not so much. I mean, we'll do a couple indicators, but I think the price action is where it's at. And then we're probably going to get a little bit more into futures with micros getting more and more popular. It's an excellent way to kind of get your feet wet into futures. Learn the platform. 2, it's a different animal to play with. So there's things that I think can be learned there. So we'll probably be getting more into that toward the end of the year, and most likely by January at the latest. But still trying to work on some different plans and stuff. Do your scans cater to non-US traders? I'm in the UK and can't use TOS. So do you use which platforms do you use TradeStation or Tasty Trade or TradeStation? Yeah, so I use TradeStation for futures, and also for Tasty Trades. I know expanding, they got bought out earlier this year with their $1 billion or whatever buyout, and Tom Sofnos and those guys are doing an excellent job rolling it out. But they want to increase their worldwide footprint. They got a pretty decent futures platform, not as robust as TradeStation. TOS I don't really use for futures because it's the latency in that for futures is pretty horrific. Tasty Trade and TradeStation are pretty much right on sync. I actually run all 3 platforms during the day with about 8 accounts. So TradeStation, most likely we're going to be using that as we get more into the futures realm, because I mean TOS is kind of good for just the chart stuff, but you can do some of that stuff obviously in TradeStation with the strategies and stuff. But when you start talking with futures, I mean you're pretty much just working off price action, support levels, and looking at patterns, continuation patterns and that type of stuff. But the scans, I mean, really the criteria, I mean, you can pretty much build it, I think, in radar scan. So could probably build something, I guess, if you wanted. I mean, there's easy language. I'm a very novice in easy language. It's different from TOS. I mean, I'm not an expert in either one, but I know enough to get around the block, so to speak. So I hope that helps. Have you done any back testing with your strategies? So Chime, interesting question. Back testing it's hard to back test when you got some of these different strategies that we shown here, because when you do back testing, you have to be careful with a couple things. One is the market that you're in. You know, if we're in an uptrending market, it's going to look a lot different than if something that's going sideways. Plus the fact the trades that we're doing, as they overlap, but you see how those butterflies, you know, I'm buying back in that outer stack fly. I'm changing the characteristics of it. So we're paying attention to, you know, we're very big on where we're placing the starting leg of that butterfly, you know, the sweet spot of the S curve on your deltas, for example, between the 22 and 27 delta on that butterfly, you know, you're at the sweet spot of your delta curve. And if you got a butterfly that kind of starts there, you got a pretty good, you know, foundation there. But sometimes you can also over optimize some of the back testing, so you got to be careful with that. But I'd recommend just doing, you know, a live account and just doing small, you know, really small positions, or use IWM or SPY, because those emotions will come into play, and how do you react to certain scenarios. Is just that's my basis. I know that people, you know, like doing the back testing, but it's, you know, some of these back testing softwares, and I mean, some of them are good, but, you know, I'm not going to try to fit everything in one box, because you can't predict some of these things that happen. Now I will say, having said that, the one strategy that we do every other week is what we call a pregnant butterfly trade. And it kind of gears to the fact of, we're looking at a directional Venus butterfly, but then we have what we call a plan D, which is a vertical in the opposite direction. And that has saved our goose many a times, and it's meant specifically for that. We call it the seatbelt, because you know, you want to go forward, the market goes backwards, and that little vertical that we bought ends up making the money in the trade. So that we're trying to account for every scenario. Obviously, you can't get everything, but I use TradeStation for options. Yeah. So I've used TradeStation for the options. You can't do certain types of trades. Their margining stuff in TradeStation is not the greatst.
Yeah, that's what I found too.
Yeah, the diagonals you can't do in the indexes, and some of the margining stuff is it just seems so old school. It's like I'm trying to put on, you know, try to do like a Venus butterfly or something. Their back-end clearing system or something it just can't handle it. I mean, I talked to their trade desk, and it's like, you know, they call you back after 3 hours or something. I was like, they say, oh, that's just the way it is. I was like, there's no max risk there. They say it needs like $250,000. It's a Venus butterfly. It's 250 max risk. It's like, well, we can't match it up on the back end. I was like, and not I'm shaming TradeStation. I mean, but you know, for the options, they need some work in there. I mean, is the VIX broken? No. The VIX is just it's a derivative, you know, obviously with the price action, but you just go where the volatility is, and obviously there's going to be periods where the VIX is low and the periods where it's high, but if you can, you know, take that VIX and again, when we're looking at trades, you know, and I tell students all the time, it's like, I don't care what butterfly you find, whether it's a broken wing or a Venus or 132, don't take the price you see after hours. I mean, take that and you know, we apply the expected move against it, and saying, hey, if it goes this direction, we want to get this price for it. You know, we want the market to kind of work in our favor to some extent. Does it work all the time? No, but it does, you know, it give us a better price placement, I guess, because we're trying to get some kind of edge. Does the Excel dashboard work only in TOS? It works in TOS. I've had a couple people that use, I think, the Parallax in Apple. I think it's the Parallax. They got the Windows emulator, and they got it to work. Other people have had issues with it. But that Excel dashboard has it has a 2-hour video that specifically goes over every nook and cranny in that dashboard. And it's a time saver because a lot of the students are full time, working whatever jobs, and it helps find butterflies very quickly. Signal service meant to offer any trading. Well, we learned the system to take this and get some experience in the live market. So I think you're talking like auto trade service. Yeah, that we don't do. And when you have unsymmetrical butterflies, you're not fully utilizing your capital risk on one side of your trade. So you consider a far out of the money spreads to utilize purchasing power that's otherwise wasted. I do take the fact of, many times, I mean, it's, there's a lot of good, people do put Brookwing butterflies, the Rudd or the, Dan Harvey's and those guys, do put Brookwing butterflies, which is fine. But the point I'm trying to make is if you're using margin on whether it be the call side or the put side, I usually tell students, try to use, not you have to, but put some kind of trade on the opposite side. If you're doing something on the put side, find some kind of cheap, Brookwing butterfly on the upside. This and the odd chance that it goes against you, because you're already tying up the margin on the put side. Take advantage and use something on the call side without sinking a lot of capital into it. So we typically don't like, like I said, paying a lot of cost for butterflies or verticals. We really stick pretty hard and true with the risk reward, like I said, with a vertical or a butterfly. So we're pretty big on that. And then when it does move in our favor, then we're going to sell a premium against it, or we're going to add a Brooklyn butterfly to it. So I hope that makes sense. Yeah.
Okay, thank you so much. Ed. I think I love the dialogue we got going there. A lot of people got involved and obviously following with great interest. I hope they follow up with you as well.
Yeah. And our adjustments made once a day? No. Some days it's like, the market doesn't move. There's nothing there. But what I do is every Thursday I try not to have more than 5 to 8 trades. I mean, 5 trades is a lot, but you start getting about 8 trades and you're just starting out, you're just drowning. I try to keep it between 3 and 5. And I go over those trades and saying, okay, if the market does this, it goes to the upside, this is what I'm looking at. If the market goes to the downside, this is what I'm looking at. So you're going to see all those trades. And, for the trades that are not, so when you're in the analyze tab, you can lock in the price, and that's if they get filled. But for those trades that I'm looking at, I leave them unlocked. So when you pull it into your toss, the ones that are unlocked are ones that are just looking at. They're not actually filled. Whether you want to pull the trigger on it and buy it or sell it is up to you. I mean, I'm showing you what price I'm looking at. But yeah, some days we don't get filled. Other days, it's a little crazy. Particularly the market's moving 50, 80 points, and it bounces or something. I think I'm huffing and puffing from 9 a.m. to noon.
Okay, guys, we're going to have to give Ryan a fair shake.
Yeah. Okay. One last question.
If you want to catch that last question.
Yeah. Ryan. Any thoughts about portfolio allocation? How much of your own capital do you allocate to your Brooklyn Butterfly? I use a multitude of strategies. It's not just broken wing butterflies. Typically, I use broken wing butterflies as an adjustment to an existing position. I'm usually starting out with a Venus butterfly because it's the amount of capital involved is minimal. Typically, I'm spending in between $2 and $3 for a Venus butterfly, and that could be as big as a 20 by 30 or 40 by 50 butterfly. And I'm using that broken wing butterfly to lock in profits. So many times what I'm looking at is if I'm buying a Venus butterfly for $2 or $3 and I add a broken wing butterfly to it, I'm getting $5 or $6 on that broken wing butterfly, and I have automatically locked in about $1,000 profit, worst case scenario. So the broken wing butterfly, I typically, my favorite scenario is doing a Venus put fly and then adding the broken wing butterfly to it, because as the market goes south or the underlying goes south against you, implied volatility is going up. And when you add that broken wing butterfly, I can go pretty wide on it. We did it the other day in an SPX position. It was, I think, a 60 point, I think it was 60 or 70 point short that I put against it as the market was coming down. So, you take advantage of the vol skew, and you can get a really large credit. So That's my ideal case, but most of the time, I'm usually starting out with the Venus and then locking in with the broken wing, adding to it. So, but yeah, if you have other questions, just shoot me an email. And I'll get to it as quick as I can.
Thank you very much, Ed. We really appreciate you taking the time.
Yep. Thank you.